Important for you to understand that CFA Institute has now split portfolio management into two different parts. So you start off with quantitative methods and then economics, and there are two learning modules coming in from portfolio management at this point, which is your risk and return part 1, and then the next one, which is risk and return part 2. And then the curriculum continues on with corporate issuers, financial statement analysis, equity, fixed income, derivatives, alternative investments, and you have your portfolio management returning again, right? And then finally, ethics. So there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. I'm not going to count portfolio management twice because I've already counted it here, but it is split into two. So what you're doing right now is risk and return part 1 and risk and return part 2. Then we have 4 other readings that are there in the second part. And it's very important to do risk and return part 1 and part 2 before you do the rest of the material, especially equity, because there's a very important topic which is called capital asset pricing model, which is actually covered over here in risk and return part 1 and risk and return part 2, which we use in equity, which we use in corporate issuers. So this sequence is very important, right? And the capital asset pricing model is something that you will understand towards the end of risk and return part 2. But before you can understand the capital asset pricing model, and this is Nobel Prize winning work, right? You've got people like William Sharpe and you've got people like Harry Markowitz who have actually won Nobel Prizes for this work. Harry Markowitz came up with the modern portfolio theory, which you will be studying. William Sharpe came up with the Sharpe ratio, which is also something that you're going to be studying. And all of this theory, when risk and return part 1 and part 2, is slowly going to build towards those theories. So let's get started. We're going to look at some of our material which we studied in quants. So this is going to build on top of your quantitative methods material where you learned how to calculate a geometric average and internal rate of return, which was money weighted rate of return, and time weighted rate of return. So we're going to have a quick look at that. We're not going to spend too much time on it because it's covered in quantitative methods, right? So I'll just show you the areas which you need to know. And if you feel that you need to go and brush up on those, please go back to the quantitative methods material and brush up on those calculations, because I'm not going to spend too much time on those calculations. I will, of course, be more emphasizing on the newer areas that you need to understand, such as what is utility theory, right? How do different investors feel with different levels of risk? Some people like to take more risk. Some people are not so comfortable taking risk. Then we'll talk about how different individuals, based on their utility compared to with respect to risk, would then go about selecting different portfolios, right? And we'll look at a portfolio of 2 risky assets, then we'll move on to many risky assets. We'll look at the power of diversification, that how you can actually improve your return without increasing your risk, rather even reducing your risk and improving your return through diversification. And that's where, Harry Markowitz comes in with this really powerful concept of the modern portfolio theory, that through diversification, it is actually possible to increase your return, right? Increase your return and actually reduce your risk. So you can go from, let's say, point A to point B, where your risk is actually coming down and your return is going up. So that is a really, really powerful concept. And then we will look at something called the efficient frontier. I'm not going to spoil it for you right now. Let's cover the first few points, and then we will get into what the efficient frontier is and how that is something which is very, very useful for us. And then how we put it together with the investors' utility theories and come up with that sweet spot for each investor, which is also going to satisfy their utility and also lies on the efficient frontier. So that's what we're going to move towards. Right, guys. So here we're going to talk about risk and return, right? How you go about making a portfolio, what does different investors' personal preferences have to do with it, right? So how then you combine optimal portfolios with optimal, with the personal preferences of people to come up with that optimal portfolio for that particular individual. Now, just some prerequisite material, right? You should know all of this from your quantitative methods. I'm just going to quickly help you revise that when you have a return coming in, it could be because of, let's say, a dividend or a coupon payment if it's a bond, right? And it could be because the price is going up. For a period, let's say a holding period, that could be any amount of minutes, seconds, even hours, days, weeks, months, right? So whatever you're holding a certain investment for. So for that period, you'll take the ending value minus the beginning value, which will give you the capital gain, plus you can add any income that it has given you divided by the beginning value, and that is what is the holding period return. You want to take the average of multiple different holding periods. So 1 year you made, let's say, 40, and the next you made 20. Well, one way of doing it, you could just take that average. But what we like to do is take the geometric average, which would be 1 plus the 40 multiplied with 1 plus the 20% return, and this to the power of half and then minus 1 is going to give you that annual compound annual growth rate, right? It is then divided into these 1 year return, and then the second year return is actually combined, not added like an arithmetic average where you would just do 0.4 plus 0.2 divided by 2, but you multiply them together. First add them to 1, then multiply them together, and then instead of dividing by 2, you do it to the power of 1 over 2 and then minus 1. Why? Because this takes into account the power of compounding, right? So this is again from your quants material. If you feel a little bit lost, please go back and watch the videos on arithmetic average, geometric average. And then money weighted return is your IRR, where we say, okay, so what are the cash flows we are getting, right? What are the cash flows we're getting from a certain investment? What are we paying for this, right? What are the cash flows we're getting? And that rate, which let's say that we call it R, that rate which will equate the present value to the future value, right? That return is called the money weighted return or the IRR. And time weighted return is not going to take the cash flows, right? So this is based on cash flows. That's why the name money weighted. It's taking the actual cash flows. Time weighted is something which is very similar to your geometric average, right? It doesn't work with dollar amounts. It just takes the percentages. So time weighted is very similar to geometric return, right? But the only difference being that geometric mean is the annual rate, so compound annual growth rate. If I just wanted to know, okay, what would have been my return after 2 years if I started with $100, right? What would be my ending balance? So that would be I would take this 40%, 1 plus 40 multiplied by 1 plus 20, and this whole thing I just multiply with 100, and then it would tell me what would be my ending. And if I wanted to know an average, an annual average, in that case I would say, okay, let me take this to the power of half and then minus 1, and then it would tell me the average. So geometric mean and time weighted return are actually connected concepts. Now, what's the high level comparison between money weighted and time weighted? Money weighted obviously is based on the cash flows, right? So the amount and timing of the cash flows is key because it is divided by 1 plus R to the power n, right? So the timing is very important and amount obviously is important. So this is basically just your IRR. Now with the time weighted, the cash flows are not taken into account. It is the percentage return that we are taking. Now, why is this so important? Because if, let's say, I am managing a mutual fund and you want to see how good my portfolio management skills are, well, I don't really have control over when the client increases the investment and reduces the investment. So when the market is not doing so well and the client is taking out money, and when the market is doing really well, the client is, adding money, but he's coming in right at the top when already the performance is there, right? And he took out all his money over here, so he missed that whole bull run. So it's not my fault that he missed the bull run, right? So if you want to evaluate my performance, it should not be based on cash flows. It should just be based on the percentage return that I have generated from each holding period to the other holding period. So this measure, which is your money weighted rate of return, is appropriate if the portfolio manager has control, right? So that would be, let's say, maybe a private equity fund or a hedge fund which has like a lockup period where investors are not allowed to take the money out. The hedge fund or the private equity fund will not allow them to take the money out, right? So for them, you could use the money weighted return. But for somebody who is just managing a fund where there is no control over when the investment is coming in and going out, then we should not use the money weighted rate of return. We should use the time weighted rate of return, where the manager does not control the timing. Right. Now, just to make sure you are comfortable with the calculation of time weighted and money weighted, please try to solve this problem. I'm not going to solve it. I will show you the solution for it, just to make sure that you have been able to solve it. And if you are not able to get that solution, you have to go back to the quantitative methods material and revise your calculation of time weighted and money weighted, right? So please pause the video, try to solve this. And if you're able to get the answer, well and good. Otherwise, please revise your quantitative methods material. Right, so I'm going to show you the answer now. So the time weighted return you should be getting is 27.98 and the money weighted rate of return you should be getting is 28.6. In terms of annualized return, so let's say you're doing something like algorithmic trading, which is like making profits every minute, every seconds, maybe some very high frequency trading is going on where the holding period is very short, right? So there could be multiple holding periods in a year. Now, if you want to know, okay, how much would my annualized return be, right? So let's say somebody comes to you and tells you, hey, please invest with me. I do really good trading. And you say, okay, what is your return? And they're like, oh, I make around 1% every month. So you're like, no, please don't tell me in months, tell me an annualized return, because then I need to compare it with my other investment avenues. And of course, they are also showing me an annualized average, a compound annual growth rate, right? So then I'll be able to compare and do an apple to apple comparison and see, okay, how much is this investment giving me? And how much is that investment giving me? So if they are saying like 1% per month, then you do 1 plus that 0.01 and then do it to the power of 12 and then minus 1. If they say, oh, I'm making 0.5% every week, then well, there's 52 weeks in a year, right? So whatever is the number of periods in a year, depending on what is their particular holding period, that is how you're going to do it. Let's say if they say, oh, I make around 0.0005 every day, and there's like 252 trading days in a year, so then you could do it to the power of 252, right? And then don't forget to minus 1 if you want it in percentage terms. Now, this is also something we've seen earlier, that obviously there's fees involved, right? So the fund manager is going to take some fees. If you want to see their return before the fees, that's called gross. After the fees, that's called net, right? And then if you want to account for taxes as well, then you would do the after tax return. And then if you want to account for inflation as well, then that's called the real return. Now, this is a little tricky, because technically the formula is not your after tax return. Let's say that's 4% and inflation is 3%. So you can't do this, that my inflation is 3% and my after tax return was 4, so I just minus the 3% inflation and I get 1. This is going to be an approximation, you can say. Right now, if the answer choices are like A says 2 and B says 0.9 and C says like 7, well, then you can just go with B, because 0.9 is the closest to 1. But if the answer choices are like 0.9, 1.1, and let's say 1%, well, then you are not going to be able to use this simple formula, which is just subtracting the amount of inflation directly. Then what you have to do is then you have to use this formula, where you would say, okay, so the rate of inflation is 3%, right? Which is shown by this pi. The real rate I want to calculate, I'm going to make that X, and then whatever I'm making before is 4%. So now essentially to get my 1 plus X, what I'm going to do is 1 plus 0.04 divided by 1 plus 0.03. 3. Instead of minusing 3, what I'm going to do is I'm going to divide it by 3, but it's going to be 1 plus in the numerator and 1 plus in the denominator. And then to get x, obviously, then I'll have to take the 1 on the other side and do minus 1, and then it will tell me what is my real return. In terms of leverage return, this is something which is discussed in a lot more detail when we get to equity, but I'll just give you a high level introduction about this, that if I am having, let's say, $100, but I'm borrowing another $100 from the bank and buying stock worth $200. Now, if the stock is going up and there's some dividend coming in, I have to first return this loan that I have taken. I have to then pay interest on this loan as well. And then after accounting for all other expenses, taxes, commission, etc., then whatever is my net benefit which I have gotten, then I will see that as a percentage of my original investment. So more on that when we get to equity. Right, now historical return and risk. So what we have seen over here is that there is a trade-off in risk and return, and let me show you what that means. So if you see over here, stocks are obviously having, in terms of risk, you can see they are having higher risk, right? But in terms of return, you can see they are having higher return as well. So risk and return compared to, if you look at bonds and treasury bills, which is also a fixed income security, the return is much lower on the fixed income securities, right? So let's just zoom in on the return first. So this is the return for your treasury bills. This is the return for your long-term bonds, right? This is the return for your corporate bonds. As you can see that the return for stocks has been much more than your bonds. And the reason for that is the higher return is not without the higher risk. So you can see that the risk is higher in the stocks as well. Yes, the return is lower for your fixed income securities, but the risk is also lower. And what is really interesting to see that if you just focus on your stocks, right? If you just focus on your stocks, compare the returns of your large company stocks, right, and your small company stocks. So small company stocks are actually having a higher return and a higher risk as well, right? So this is a very interesting space to be in if you have the risk appetite. So we'll be looking at risk appetite as well, that how different investors would react differently to the amount of risk in an investment. So of course, it's not for everyone. And that's where the whole portfolio theory comes in, that, okay, how do you find that sweet spot, which is an optimal portfolio as well, and is also going to be something which will maximize the happiness or the utility of the investor. But the point you need to take away from this particular chart is that your risk, which by the way is measured with standard deviation, and this is something you should know by now from your quantitative methods material, and we're talking about total risk here, because very soon you will see another measure for measurement of risk which is not going to be standard deviation, but more on that later. For the time being, risk is measured through standard deviation, and the higher the return usually is going to come with a higher risk, and lower return would then obviously come with a lower risk. Right, let's take a break here. Then we will come back and jump into what are the assumptions we make, and we'll cover those assumptions before we actually get into the material regarding your portfolio management and your modern portfolio theory, because the assumptions are very, very important, because without these assumptions, we cannot say what we're going to say. So anyways, let's take a break. We'll come back and then jump into this material.